Unilever owns some of the most recognizable brands in the world, including Dove, Vaseline, Axe, Knorr, Hellmann's, Cif, and Persil. For decades, that enormous collection was supposed to be one of the company's greatest strengths. If consumers bought less food, beauty could compensate. If one country slowed, another might grow. But investors increasingly see the same diversification as a weakness. Unilever is now doing something that would once have sounded backwards, deliberately making itself smaller in the hope that Wall Street will value it more. The transformation has already begun. Unilever separated its ice cream operation, creating the standalone Magnum Ice Cream Company. Then it agreed to combine its remaining food business with McCormick, in a transaction Reuters valued at roughly $65 billion. When the restructuring is complete, the company behind Dove and Vaseline will be far more concentrated around beauty, well-being, personal care, and home care. CEO Fernando Fernandez is effectively betting that fewer categories will produce faster growth, better execution, and eventually a higher valuation. That creates the central question: why would a company voluntarily give up businesses that are still profitable? The answer has less to do with whether mayonnaise or ice cream make money and more to do with what investors believe a consumer company should look like today. Unilever currently trades at a substantial valuation discount to more focused competitors. Reuters reported that the company was valued at around 11.5 times enterprise value to core earnings, compared with roughly 14.8 times for Procter & Gamble, 17.5 times for L'Oreal, and 22.7 times for Coca-Cola. Those companies are not identical, but the gap illustrates a larger market preference. Investors are increasingly willing to pay more for businesses they consider easier to understand, faster growing, and more focused. This is called the conglomerate discount. Imagine two businesses each generate $1 billion of profit. One is a focused beauty company with a clear strategy, common customers, and similar distribution channels. The other owns beauty brands, food brands, cleaning products, and several unrelated operations, each requiring different marketing, innovation, and management decisions. Investors may value the first company more highly even if current profits are similar, because they believe management can allocate capital more efficiently and execute more consistently. Diversification once looked like protection. Today, complexity can look like bureaucracy. Unilever has experienced this problem for years. Its scale is enormous. The company's products are sold in around 190 countries, and roughly 3.7 billion people use them every day. But running hundreds of brands across many categories can spread management attention thin. Unilever itself has been reducing complexity, concentrating resources on its strongest power brands, simplifying product ranges, and trying to make the organization faster. In 2025, power brands already represented 78% of turnover and grew faster than the company overall. The new strategy pushes that logic much further. Instead of asking every category to justify its place inside Unilever, management is concentrating capital behind areas it believes can deliver higher structural growth: beauty, well-being, and personal care. Unilever's own medium-term presentation shows an ambition for roughly two-thirds of turnover eventually to come from these categories. Its strategic priorities emphasize premium products, digital commerce, the United States, and India. Why these businesses? Because selling a more expensive skin serum, deodorant, or wellness product can have very different economics from selling packaged food. Beauty products are highly brand-driven. Consumers may pay significantly more for a product if they believe it has superior ingredients, scientific benefits, or stronger cultural appeal. New formulations can create premium versions of existing products. Social media can generate demand quickly. Small brands can also expand internationally without requiring consumers to completely change their daily routines. Unilever is already trying to exploit those characteristics. Its beauty and well-being division generated 12.8 billion euros of turnover in 2025 and grew underlying sales by 4.3%. Personal care produced 13.2 billion euros and grew 4.7%. By comparison, foods generated 12.9 billion euros, but underlying sales grew only 2.5%. Food remained profitable, with a strong underlying operating margin, but it was growing more slowly than the categories Unilever wants to prioritize. That distinction is critical. Unilever is not necessarily selling food because food is bad. It is selling food because capital may earn a higher strategic return somewhere else. Imagine you own 4 stores. All 4 make money, but 2 can realistically grow 3% a year while the other 2 might grow 7%. If management time and investment are limited, keeping everything is not automatically the best decision. Selling the slower businesses can free capital and attention for the faster ones. That is the theory. Procter & Gamble provides an important precedent. Years ago, P&G dramatically simplified its portfolio, selling numerous brands and concentrating on fewer categories where it believed it had stronger competitive advantages. Reuters noted that investors now frequently cite P&G as evidence that a consumer conglomerate can shrink, improve execution, and eventually command a higher valuation multiple. Unilever wants to prove it can do something similar. But selling businesses is the easy part. The difficult part is proving that the remaining company actually performs better. This is where the story becomes more interesting. Unilever has already started showing signs of improvement. Reuters reported that sales volumes recently reached their strongest growth rate in more than a decade. In 2025, underlying sales increased 3.5%, including 1.5% volume growth, while underlying operating margin improved to 20%. That combination matters because consumer companies often generate growth by raising prices. Volume growth means customers are actually buying more products, which generally provides a healthier foundation for long-term expansion. Management is also changing how it builds brands. Unilever calls its approach desire at scale. Behind the corporate language is a fairly straightforward idea. Invest more aggressively in fewer brands, make the products more premium, use science to create clearer benefits, and market them where younger consumers actually spend attention. Dove is a good example. Rather than treating soap as a commodity, Unilever has extended Dove across body wash, deodorant, skincare, and haircare, often attaching new technology or benefits to familiar products. Vaseline has followed a similar path, moving beyond basic petroleum jelly into more premium skincare formats. In well-being, brands such as Liquid IV, OLLY, and Nutrafol give Unilever exposure to categories that behave more like lifestyle or health-adjacent products than traditional packaged goods. This strategy also changes where Unilever spends acquisition money. Instead of buying another giant food company, it has been expanding beauty and personal care with brands such as Minimalist, Dr. Squatch, and Wild. The objective is not simply to own more brands. It is to own brands that can grow faster, command premium pricing, and perform well through digital channels. There is another benefit to becoming smaller: operational simplicity. A company selling hundreds of variations across many categories carries hidden costs. Different packaging, ingredients, factories, marketing campaigns, and supply chains all create complexity. Unilever says it has already reduced the number of product SKUs in parts of the business by more than 20% since 2022. Fewer products can mean larger production runs, simpler logistics, and more concentrated advertising. This is why the restructuring is not just financial engineering. The theory is that a smaller portfolio lets Unilever put more money behind products that matter, move faster when consumer trends change, and reduce resources spent maintaining marginal brands. But the strategy also creates a paradox. Food is slower growing, yet it is not necessarily less profitable. Reuters highlighted exactly this concern. By reducing exposure to food, Unilever is giving up part of a business that historically generated attractive margins. Its foods division reported a 22.6% underlying operating margin in 2025, actually higher than Beauty and Wellbeing's 19.2%. Investors therefore need proof that faster growth elsewhere eventually compensates for the profit Unilever is giving up. The McCormick structure creates another complication. Unilever shareholders are expected to own roughly 55% of the combined food company, while Unilever itself will retain close to a 10% stake. That means Unilever is reducing direct operational exposure to food without completely eliminating its financial connection to it. Some investors worry this makes the restructuring less clean than it appears. And investors have heard turnaround promises before. A portfolio can be reorganized quickly on a PowerPoint slide. Changing how a global company with thousands of employees actually operates takes much longer. A narrower Unilever still has to launch products consumers want, compete against L'Oreal and P&G, defend market share, manage commodity costs, and execute consistently across dozens of countries. That is why one portfolio manager quoted by Reuters said investors may need 3 or 4 quarters of strong volume growth before they believe the turnaround is real. The stakes are especially high because Unilever is trying to become more premium without abandoning its massive mainstream customer base. Premiumization sounds attractive because higher-priced products can generate better margins. But billions of Unilever consumers live in markets where affordability matters enormously. A Dove product in the United States and a sachet of shampoo sold in India may serve completely different purchasing power. Unilever has to move the portfolio upward without pricing ordinary consumers out. That balance may ultimately determine whether the strategy works. If Unilever can combine the distribution scale of a mass-market giant with the growth and desirability of a more focused beauty company, investors may reconsider the discount applied to its shares. But if growth remains mediocre after food and ice cream are gone, the company will have sacrificed diversification without receiving the valuation benefit it expected. This is what makes the restructuring much larger than a simple asset sale. For most of the 20th century, corporate strategy often rewarded scale and diversification. Bigger companies could spread risk, negotiate harder with retailers, and use global distribution to sell almost anything. The modern market is increasingly rewarding focus. Investors want companies to explain exactly where growth comes from. Managers are under pressure to concentrate capital on their strongest businesses. Conglomerates from General Electric to Siemens have spent years breaking themselves into simpler pieces. Now the same logic is moving deeper into consumer goods. Unilever is effectively testing whether one of the world's largest collections of consumer brands became too large for its own good. The company once believed owning more categories made it stronger. Now it is betting that the opposite is true. If Dove, Vaseline, personal care, and well-being can grow faster once management stops dividing attention across ice cream and food, Unilever could emerge smaller in revenue categories, but stronger in valuation, innovation, and long-term growth. And that would make the company's strangest strategic move surprisingly logical. Unilever may need to sell some of its most famous businesses in order to become more valuable.